So now we can look at what's happening at the cash side and looking at total bank cash, foreign bank cash, and getting a breakdown of what is happening on the different cash levels, and then what does that mean for small businesses, large businesses, the consumer in general. So this is just highlighting where things sit at the post-COVID, just given the amount of total bank cash. So you can see that we're back to all-time highs. But when you look at foreign bank cash, and then the total, you can see that the pressure remains on the foreign side as U.S. bank cash remains elevated and just total bank cash in general. So again, this comes down to where are foreign companies? What have they pulled out of our market? What is in their market? As pressure remains, again, coming full circle to what is fiscal stimulus going to look like? What are some of the economic growth potential or opportunities that could come into the market that they're going to have to finance, which again is this underlying issue that remains. So then when we look at just, this was a snapshot from the overnight. So when you look at the 10-year yields is much lower than what PMI suggests. So again, I'm not saying PMI is 100% right, and I'm not saying that 10-year yield is 100% wrong. It's always going to be it's going to be a marriage in the middle, and you're going to see both of them converge on each other. But they're still going to pull the yield up. And that's why, no matter what is happening in the market, the drive is going to be north in terms of where we sit today versus where we've set in previous years. And that global PMI number, I still think has downside projections. Now, it's still averaging at that 53. I am not saying it goes contractionary. I think it moves much closer towards this 51 level and something closer to what we're seeing coming out of China, which is 50 to 51, that I think is going to become a bit more of a common thread, especially when we turn to Europe and we start to look forward into some of the US data points, given where February closed and kind of March is kicking off. So, but either way, this is going to put a little bit of pressure on growth, but still drive that US 10-year yield higher. And when we think about the different trackers, because the IIF does a really good job of looking at that real money flows to emerging markets in dollars, you can see that we're starting to see some of that outflow as guys are looking to pull back from the emerging market debt world, because one, you're getting a better yield now than you have previously in the US markets. It's obviously safer versus some of these EM components, but it's also across the board. You're seeing the pressure on China equity, EM equity, EM debt is all seeing this pressure, which again is why we think the emerging market will remain a bit soft in terms of where things are as yields drive higher. And that 10-year, US 10-year starts to, other countries start to trade closer and in line with where the US 10-year is. Now, with that being said, you still have to consider what is the US consumer doing, because the US is a buyer of stuff. And when we look at the average weekly hours of all private sector employees, it actually dropped, because even though we did get more jobs, we got more part-time jobs, not full-time jobs. And this is looking at who wanted to work full-time but couldn't. And that's why this has a lot of, I think, pressure to the downside, where, especially when you consider the quality of jobs that are likely to come back over the next 2 months, which is going to be leisure and hospitality, a lot of those can be forced part-time, because we're still reopening restaurants, but it's at 50%, not 100%, or it's at 75%. So if you had 10 servers, can you operate with 7 and 2 of them work part-time versus full-time? And these are things that, again, are going to weigh on what is the job recovery look like on the back end of this, COVID starting to normalize and go away. And at the same time, we're starting to get a little bit more of a business optimism. It missed expectations. Expectations were at 97. It came in at 95.8, but it's still bouncing. It's still getting a little bit better versus where we were, but it's still under pressure that we saw in 2016, until we obviously got a huge amount of stimulus at the back end of 16, which shot up that move. But it was also, now to be very clear, there is also a lot of politics in this, because what also happened at the back end of 16, it was President Trump. So again, that's where you get these moves. Then Biden is elected, you get the drop. So you have to kind of weigh what this is in general. So that, this is just, looking at things in aggregate. But this optimism can be skewed. But the one thing that is much better looking to use this for is good time to expand. So the problem right now is, and we're starting to see tightening on debt and lending in Europe, which is again going to kind of weigh on some of the European numbers, which we'll go through in the next segment. But small business is saying that, is it a good time to expand? And the resounding answer is no. And we're seeing some contraction, and it's really being driven by small business sales expectations are shrinking again. So now they're saying that they expect small business sales are going to decline in March. And that's why, or I should say going forward, and that's where we start to see some of this pressure on what are PMIs going to say? What are ISM services going to say? Where is there going to be some of this pressure, given that's looking at more of an aggregate, and that's picking up some of the larger entities which are feeling a little bit better about the situation versus where the small businesses are. But again, it's still showing that pressure remains in the system and in the market, and this is going to deter new hiring, and again, also limiting the amount of salaries that are available to pay to individuals. And when you think about jobs hard to fill, it comes down to the efficiency side. It comes down to, well, the jobs are there. If you look at Indeed, we're back above where we were pre-COVID. There's job postings. And this is the quote that was pulled from this. So businesses are increasingly facing labor shortages. Unemployment benefits have been much higher than normal. Combined with the one-off government payments, it's been less attractive for many workers to get back into the labor force. That's the one side. The other side, which is a bigger long-term issue, childcare challenges exacerbate the situation. The index of job openings hard to fill hit a record high because childcare prices are through a roof and only getting worse. So that's why you start to get these issues of, well, even if I want to work full-time, it's still costing me a lot to put my child in childcare. So maybe I'll work part-time. I'll work 2 days a week, 3 days a week, and not have to pay that exorbitant amount in childcare, which is, again, leading to some of these issues because there's jobs out there, but they're having trouble filling them. Now, with all of that being said, looking at this, the raising, so if you look at the amount of businesses raising prices, it's the highest going back to 2014, or planning to raise prices. It's the highest going back to 2014. Prices are going up. I can't say this enough for those that want to fight me on inflation, that want to fight me on all these different, I mean, this is the data. I'm not making this up. This is what is happening. I'm experiencing it in my own personal life. The data is telling me it's there. I don't know what else to tell you at that point. And then when we look at the fundamentals on the upward trend, so when you look at Pantheon, primary rental models year over year, rent is going up. Weighted primary rent, is just, we're going to get this pivot up, and that's going to drive things higher. Now, when you look at just on the rent side, but because just talking about things where individuals believe that there is not a push higher for some of these inflationary side, well, you get this, but also airline tickets. So how much is the airline willing to take? How much pain are they willing to absorb to get people to fly, given the fact that jet fuel pricing continues to drive higher because it is still priced off of oil, and oil is at WTI is at $64.50. So if you think about where we were pre-COVID, during COVID, and now post-COVID, how cheap can you maintain the airline ticket when the lion's share of your airline ticket cost is the jet fuel that is in the belly of the plane? And if you have less you have less business travelers, because typically the front of the plane finances the back of the plane, how are you going to finance that? Where are you going to see this pressure? Which is why I think this is a very good way of looking at how quickly or what rebound we could get in airline tickets in general. Now let's think about, well, what is going to happen on work from home? So in 2020, the preferred place to start a technology firm for long-term success, 6% said distributed or remote working from day one. So now in 2021, that has gone to 41.6%. So we went from 6% to 41% are saying that it's okay and good to be distributed or remote working. That, again, points to where this pressure continues to come into, where the issues on work from home will become more permanent, not to the degree that it is today, as we've shown multiple time and time again, but it's going to become a more common practice, which is going to limit how much gasoline consumption will we get during that time of, during the work day or the work week versus the, in the before times, as I like to call the pre-COVID side. So now when we look at home base, you can see that we've had a fairly stable move in terms of, we had a little bit of an increase, but the pressure still remains on closing this gap. We're still about 30% off, and this is weighted towards that small businesses. So you might say, well, they're lying. They're not saying they're being too political because they're just upset that Biden won and Trump lost. And it's like, well, no, that's which is true. I mean, you just look at the numbers. It's a political view, but also here's where you continue to see this pressure as we go into March, which again, February had a little bit of an increase. You see the little pop, but it's just not showing a huge resurgence, which leads us to where are some of these jobs coming in? So government lost jobs, construction, some of that is seasonal. But when you think about leisure and hospitality coming back, again, the part-time growth, professional and business services, education and health services, a lot of those components are becoming more, I don't want to say permanent work from home, but a flexible schedule is now a desired view. And then the retail trade. So when you look at retail and leisure and hospitality, the massive growth, which is a positive, not saying it isn't, but that's where we're getting some of that part-time. So that, again, leading back to the wage compression and what can people actually spend money on. And then when we break this down into pre-COVID, post-COVID, you can see that we're still well below a lot of these levels that we've had in the before times. As we see manufacturing, as we see some of these movements, they're all moving in the positive direction. But then we still have some of these slowdowns when you look at what's happening on the lower end with air transport, clothing and clothing accessories. But apparel manufacturing is up, but their sales jobs are down. And that's where we continue to see this pressure in general, where it's, you had oil and gas extraction or oil and gas in general. You had the big spike coming down a bit. Now I think you're going to get this coming back just because there's a certain amount of issues that we're coming into, obviously weather. So there are going to be some adjustments, but you can see that we're still struggling to get back to that normalcy. And that's when you look at that non-farm payrolls that, when you look at the recession in 2008, 2009, we had 8 million decline and then we're still at 9.5 million, just to give you an idea of where that pressure remains, where it seems like we've recovered so much, but then putting into the context of previous, there's still a lot of wood to chop, and it's been a very slow move, especially as we've had some of these, some of the wholesalers, we've seen their sales continue to accelerate. So they have to go out and refill the inventory. Now, what does that mean? That means that they're going to refill it at higher prices. Again, leading to why we continue to believe that prices are going to go up as you have to refill and buying new. And just to, not to beat this to death, but when we look at jobs below peak by earnings tier, you can see the upper has started to recover a little bit, but the lowest third continues to worsen. So we have prices going up as the lowest third component of just jobs gets worse. The middle third stays flat, and you get a little bit of a benefit of the upper third. Again, this is where that spending becomes that bigger headwind. with these shortfalls as those lingering job shortfalls stay in the market. But this is another way to look at it. But let's look at what is happening on the total initial claims. So total initial claims from last week was actually up 4% because of the initial claims and the pandemic UA initial claims in general. So we still are stuck in this weird conundrum between where are we really going to get some of these individuals back to work, which is why when you look at the pandemic emergency unemployment compensation, they continue to move higher. So when we look at mid-February, because this is more of the audited version, so we still have 18 million people that are getting some form of unemployment, with about about 11.5 million still sitting there on some form of pandemic support, or closer to 12.3 million. So here's where we continue to see this pressure on, okay, well, regular is starting to go down, but you're still getting people that are stuck on this pandemic unemployment. And this is the extended stuff. These are people that have already been unemployed for 26 weeks and still can't get a job. Again, speaking to their desperation, maybe they'll look to take that lower salary. That's going to be pushed to the side as stimulus comes through. But again, this is where we continue to see these pressure points, which is why when we start turning to the EM commodity FX and where the situation is on the emerging markets, because it's not just a U.S. problem. This is a global problem. An emerging market is going to continue to be under pressure, even as when you look at what's happening as the commodity index has gone up, you should have gotten a benefit from the emerging markets that sell into this. But as you have U.S. Treasury yields going up, that's putting that pressure on that EM currency, which is why when you think about, okay, well, so EM currencies are having a problem. EM emerging markets are, well, what's happening at the housing side? What's happening with the basis in the U.S.? So the U.S. consumer anticipates a 9% jump in home rental prices by next February. If you look at Case-Shiller, if you look at home prices, if you look at expectations, this is not a bad number to expect, given the fact that Case-Shiller is now over 10.3% on the 20 city level. We're continuing to see city prices go up, rents are going up. Like we showed, the previous marriage between rates and everything else, which is, again, driving this higher, which is why people are going to be less likely to spend, because they want to make sure they have this in the bank to protect themselves. So, but what costs are going up internally? So this is when we start turning a little bit and looking at, well, why is fracking good? Why is there some benefit? And you start looking at the amount of electricity that is being used for heat and the amount of capacity in utility and gas. And this is utility gas. And that's why when you think about gas prices going up, the amount of problems that causes to the poorest individual who is going to be the most sensitive to price. So when you look at electricity prices and gas prices, this gives you kind of a concept of, well, electricity is generated using a lot of natural gas and coal, but let's just say natural gas, and people heat their homes with gas. So having cheaper natural gas, right now it's at $2.69, this is going to be a net benefit to some of these individuals who are seeing their pressure continue to mount on just the affordability of their lifestyle. And then when you look at where are the electric heaters, and you can see where the electric heaters are, again, harking back to the Texas issue, there's an electrification mandate in New York, Rhode Island, Massachusetts. So you're going to see more electric heaters get pulled into the Northeast, which again is going to become a main source of heating, which is just going to pull harder on the grid, which is just going to increase the cost of electricity as we try to replace it with things that really aren't base load, creating a bigger problem in general. And that's when we start to look at what is the rise and fall. So when we look at the Midwest, that has come down a bit. Obviously, there's a lot of natural gas. But when we look at the West, when we look at National, South, there is a big push to increase electrical heating, speaking to the importance of base load and how do we make sure we have enough to protect ourselves from additional downside. And then when we look at, heat pumps are big in the South and nowhere else. And that's just the way that the structure is being created. But again, as some of these things change and the inability to tie into natural gas, you're also seeing some home prices go up because they're trying to do things like more insulation, better windows, things that are driving up the price of the home. Now, obviously 30-year rates are really low and that can be tolerated. But as rates start to go up and the 30 years starts to get under pressure, well, that's when we start to see some of these prices where we look at month supply has tightened significantly across the nation and all pricing tiers. So there's a push to build more when we look at all the different factors that we've seen and the indicators. There's, guys are building and it's pushing up prices across the board. So when we look at the high end is going up, but it's pulling up even the lower end. And this comes to what is the affordability? What can people actually afford? What is the likelihood of them getting in there? And if their cost of operating the home goes up, electricity, natural gas, it makes it harder to afford to stay in that house. Low rates makes your monthly rate cheaper, your monthly mortgage cheaper, helping you on the back end. But again, this is where we start to get some of these pressure points that I don't think are talked enough about when we start looking at what is fracking done, what are some of the benefits of having cheap energy in the United States. And then when we look at, obviously, that spec home building. So when you look at people that are buying and they haven't even started yet, you get an idea of kind of where that growth is and how this still has legs. Like I keep talking about how there's going to be pressure in the market. There's a lot of volume, but people are still buying things and they haven't even been built yet. So this is going to support durable goods. This is going to support manufacturing because a lot of these things still have to be purchased. So again, there's still some of that longevity, but as we see prices going up on the raw material side, it's going to push prices up on durable goods. Again, keeping this inflation moving to the upside in general. And then when you think about, okay, well, the hotel side, because, well, as people get back to feel comfortable, they're going to go back to travel. Well, lodging has a 30-day delinquency rate of nearly 20%. So maybe even if people want to go travel again, how many hotels will be left? Because people are still struggling. They're still not seeing the hotel run rates that they need, which is putting a lot of these into 30-day delinquencies on the lodging side as well as the retail side. So troubled borrowers secured breaks of 6 to 18 months in their debt last spring as the pandemic shut large parts of the economy. But nearly a year later, some lenders are running out of patience and don't have the ability to keep extending credit. So even as we're starting to get to this pivot point, if we still remain low on the back end of travel, retail, hospitality, they're trying to pay less. They're trying to keep people part-time instead of full-time. But we're going to start to see these rolling defaults, which will put additional pressure in that market. And then when we think about the personal savings rate, obviously we're going to get that spike that we saw. But when we look after another massive spike in savings after the next stimulus package, the problem is, and I agree with parts of what B of A is saying here, the spike is going to be limited because people have been living out of savings. So even though we're going to get that move up, it's still going to be muted versus where I think the market is hoping and or expecting, given the pressures that we've been highlighting and that we went through again at the top of this segment, in the last 3 segments in total. So now we're going to pause here and turn in the next segment to Europe, and we're going to try to bridge that gap with grains as well and the importance of where some of this inflation is really coming into play.